There is one force in markets so powerful that entire fortunes were built on it, and it requires no prediction, no genius, and no secret information. It is the most reliable edge that has ever existed, and here is the strange part. Almost nobody can actually use it. Not because it's hard to see, a child can see it, but because using it demands that you do the single most psychologically uncomfortable thing a human being can do with money, which is nothing. Just hold. Let it run. Sit still while a winning position gets more and more right, and do not touch it. The force is the trend. And the reason most traders never profit from the most obvious edge in existence is that every instinct you have is built to fight it. You take profits early to feel safe. You short strength because it has to pull back. You buy weakness because it has to bounce. Every one of those instincts feels intelligent, and every one of them is you fighting the one thing that could have made you rich. And I need to reframe something before we go further, because it changes how you'll hear everything else. When you cut a winner too early, or short a market just because it's strong, that is not a discipline problem. You are not weak, and you don't need to try harder. What's actually happening is that your nervous system, the same ancient survival machinery that kept your ancestors alive, is running a threat assessment. And it has decided that this open profit, this uncertainty, this thing that could reverse, is a danger to be escaped. So it floods you with the urge to act, to grab the safety of a locked-in gain, to end the discomfort. That urge feels like logic. It is actually protection. Your brain is not trying to make you money. It's trying to keep you safe, using a map of the world built for a savanna, not a chart. And here's the part that matters. You cannot white-knuckle your way past a nervous system that believes it's protecting you. More willpower just makes the war inside louder. The way through is not force. It's understanding what the old survival program is trying to protect and teaching it gently that holding a winner is not actually a threat to your life. Keep that in mind, because every instinct we're about to talk about is this same protective machinery misfiring. John Murphy built the foundation of technical analysis on one idea above all others. The trend is your friend. It sounds like a bumper sticker, so people underestimate it. But underneath that phrase is the most important observation in all of trading. Markets move in trends. Those trends tend to persist, and a trend in motion is more likely to continue than to reverse. That's it. That's the whole edge. Not complicated. Murphy defined a trend structurally, and it's worth burning into your mind because it removes all opinion. An uptrend is simply a series of higher highs and higher lows. Each push-up goes a little further than the last, and each pullback stops a little higher than the last. A downtrend is the mirror, lower highs and lower lows. And a sideways market is neither, just chop. That's not analysis, it's observation. You don't need to know why. You need to know what, and the what is written on the chart in a language of higher highs and higher lows that never lies about direction. Murphy also taught that trends exist in degrees, nested inside each other like waves within waves. There's the major trend that lasts months or years, the intermediate trend that lasts weeks, and a short-term trend that lasts days. And they can point different directions at the same time, which is where most traders tie themselves in knots. The daily chart is falling while the weekly is rising. So they short the daily dip and get run over by the weekly uptrend reasserting itself. The lesson Murphy drilled is this: know which trend you're trading and never let a smaller trend talk you out of respecting the larger one. The big money is made by aligning with a major trend and using the smaller pullbacks only as entries, never as reasons to fight the whole. When your time frame and the dominant trend point the same way, you have the wind at your back. When they fight, you are guessing. Let me give you the deeper reason trends persist. because once you understand it, you'll stop being surprised by moves that shouldn't keep going. A trend is not a line on a chart. It's a slow migration of belief across thousands of people. And belief moves at human speed, not at the speed of a single headline. When a real uptrend begins, only a few participants believe. As it rises, it converts skeptics one by one. The trader who swore he'd short it capitulates and buys. The fund that dismissed it starts a position. The person who sold too early buys back in with regret. Each convert adds fuel. And there are always more people who haven't yet believed than people who already do. That's why trends run far longer than logic says they should. Because logic is instant and belief is slow. The trend is the visible track of a crowd changing its mind in slow motion. And you cannot know when the last skeptic has converted, which is exactly why you don't guess the top. You wait for the structure to tell you the migration has reversed. Murphy's higher highs and higher lows are just the footprints of that migration, printed on the chart for anyone patient enough to read them instead of arguing with them. So if the trend is this obvious and this powerful, why does almost everyone trade against it? Because trading with the trend feels stupid and trading against it feels smart. Sit with that, because it's the whole psychological trap. Buying something that has already gone up feels like chasing, like being late, like the fool who arrives at the party as it's ending. Shorting something that has already gone up feels clever, contrarian, like you see what the crowd doesn't. Our entire education rewards us for spotting what's overvalued and betting on the correction. But the market does not pay you to be clever. It pays you to be aligned. And the trend, by definition, spends most of its life looking overextended to someone. Every trend that ran for a year looked too high at month 2, and the smart contrarians who shorted it, they were carried out. The discomfort you feel buying strength is not a warning. It is the toll you pay to ride the move that everyone who felt comfortable missed. Mark Douglas explained the mechanism underneath this, and it connects everything. He said traders don't trade the market. They trade their beliefs about the market, and the deepest belief most of us carry is that things which go up must come down, that what rises is due to fall, that fairness demands a reversal. That belief is true in many parts of life and poison in trading. A trend does not owe you a reversal. It does not know it's high. There is no ceiling written anywhere. When you short a strong uptrend because it feels too high, you're not analyzing the market. You're imposing your belief about fairness onto something that has no obligation to be fair. And the market will happily take your money for the lesson because there are always more buyers willing to pay more, right up until one day there aren't. But you cannot know that day in advance, and it feels too high has never once been that day's reliable signal. Let me make the nervous system piece concrete, because it's the real reason holding a winner is so hard. Picture your ancestor on an open plain. A rustle in the grass could be the wind, or it could be a predator. The ones who survived to become your ancestors were the ones whose nervous systems treated uncertainty itself as a threat, who acted fast to remove the not knowing. Because in that world, sitting calmly in uncertainty could get you killed. That machinery is still inside you, unchanged, and it does not know the difference between a saber-toothed cat and an open trade. So when your position is up and could reverse, your survival brain reads that uncertainty exactly the way it read the rustle in the grass, as a danger to be escaped now. It floods you with the urge to grab the profit, to end the not knowing, and it feels overwhelming because it's the same signal that once meant life or death. This is why the trend is so hard to ride. You're not fighting the market. You're fighting 100,000 years of survival wiring that mistakes a winning trade for a threat. And you cannot out-discipline that. What you can do is recognize it. That surge to cut the winner is not insight. It's an old alarm going off in a situation it was never designed for. The moment you can see the alarm as an alarm, instead of obeying it as truth, you begun to update the map, and that is the only thing that actually works. Now let's look at the people who actually harvested this force, because they prove it isn't theory. Richard Dennis and his turtles traded trends almost mechanically. Buy new highs, sell new lows, and hold. That's a caricature of the system, but it's directionally true, and it produced hundreds of millions of dollars. Think about what buying a new high means emotionally. It means buying the thing at the most uncomfortable possible moment, when it has never been more expensive, when every instinct screams that you've missed it. The turtles were trained to feel that discomfort and buy anyway, because a new high is not the end of a move, it's often the beginning of the part where nobody is trapped above and the trend runs cleanest. They weren't predicting. They were obeying the trend and enduring the feeling. Ed Seykota is the purest example. His systems were trend following, and his results compounded at rates that still sound invented. But listen to how he described the actual work, because it wasn't about entries. He said the trend is your friend except at the end where it bends, and that the whole game is to ride the winners and cut the losers. Riding winners sounds easy and is the hardest thing in trading, because a winning trend tests you every single day. Every day it's up. A voice says, take the profit. Lock it in. What if it reverses? Seykota's edge was not seeing trends. Everyone sees trends. His edge was the psychological capacity to sit through the discomfort of an open profit getting larger without touching it, letting a small number of enormous trends pay for everything. Marcus described watching him hold positions that would have made most traders faint calm the entire time, because to Seykota, an open winner wasn't a temptation. It was the whole point. And here's the mathematical reason this matters so much. The reason cutting winners early is so quietly fatal. In trend following, and in most real trading, the majority of your profit comes from a tiny minority of your trades. A handful of massive winners pay for all the small losers, and then some. Dennis said as much. A small percentage of his trades produce the bulk of his profits. Which means if you cut your winners short, if you take the quick profit every time because it feels safe, you systematically amputate the exact trades your entire edge depends on. You keep all your losers full size and clip all your winners small, which is the precise inverse of what works. The trend is the mechanism that produces those rare giant winners, but only if you let it. Take profits early and you'll have a high win rate and a shrinking account, which is the most confusing way there is to go broke. I want to name the specific feeling that makes people cut winners, because if you can see it clearly, you can stop obeying it. It's called anchoring, and it works like this. The moment your trade goes in a profit, your brain quietly moves the goalpost. A gain of $500 stops feeling like a gain and starts feeling like your money you now own and could lose. So a winning trend that pulls back slightly doesn't feel like a smaller win. It feels like a theft. Your brain is comparing every tick to the highest point the profit ever reached, and every dollar below that peak registers as a loss, even though you're still deeply in the green. That's why holding a winner is agony. You're not comparing it to your entry, you're comparing it to the best it ever was, and by that cruel yardstick, a winner is disappointing you constantly. Douglas said the market can't put you in a losing state of mind. Only your own mental framework can, and this is the perfect example. The trend is doing beautifully. Your anchor is the only thing making it hurt. The fix is to compare the trade to your plan, to the structure, not to its high water mark, because the structure is real and the high water mark is just a memory your fear won't put down. Now, trends do end, and the fear of the ending is what makes people exit too early. So let's replace that fear with structure. A trend does not end because it feels high. It ends when its structure breaks. Remember Murphy's definition. An uptrend is higher highs and higher lows. So an uptrend is intact by definition until it fails to make a higher high and then breaks a prior higher low. That's the signal, not a feeling, not a round number, not a guru's target. The structure itself tells you when the trend is in question, and it's usually far later than your fear wanted to exit. This is the gift of a structural definition. It lets you hold through the scary pullbacks that are still higher lows and only step aside when the pattern of higher highs and higher lows genuinely breaks. You stop guessing the top and start responding to the chart. The trend tells you when it's over. You don't have to predict it. You have to listen. Paul Tudor Jones gave one of the most famous versions of this discipline, and it saved him. His rule was to watch the 200-day moving average, a simple line representing the long trend. And his principle was blunt. He did not want to be long below it and did not want to be short above it. One line, dividing the world into with the trend and against the trend. It sounds almost too simple for a legend, and that's exactly why it works. In 1987, that kind of trend discipline had him positioned for the crash instead of destroyed by it. The moving average is just a way to make the trend objective, to turn which way is this going into a line you either respect or you don't. Murphy taught moving averages as exactly this, a smoothing of price that turns the noisy question of trend into a visible, tradable answer. Above the line, the trend is your friend and you treat pullbacks as gifts. Below it, that same friend has become your enemy, and every bounce is a trap. So let's turn this into something you can actually do. 5 practices for trading with the trend instead of against it. 1. Before any trade, name the trend on 3 time frames out loud. Is the major trend up, down, or sideways? The intermediate? The short term? If you can't answer, you're not ready to trade, you're guessing. And the rule that follows is simple. Only take trades in the direction of the larger trend you're respecting. Counter-trend trades feel smart and pay the worst. Leave them to people with more ego than money. 2. Use pullbacks as entries, not as reversals. In an uptrend, a dip to a higher low is not a warning. It's the discount you were waiting for. The crowd sees a pullback and feels fear. The trend trader sees a pullback and feels opportunity because the structure is still intact. The moment to buy strength is often right after it scares everyone with a shallow dip that holds above the prior low. Same event, opposite emotion, and the emotion you feel is the tax the crowd pays that you get to skip. 3. Define your exit by structure, not by profit. Decide in advance that you will hold until the trend structure breaks, until a lower high and a broken higher low, or until price closes the wrong side of your moving average line. Write it down before you enter, because in the moment, the open profit will beg you to take it early and the fear will disguise itself as prudence. The whole point of a structural exit is to protect your winners from your own nerves. You are pre-committing to ride the trend, so that in the heat of the move, the decision is already made and your fear doesn't get a vote. For expect to feel wrong the entire time you're right. This is the one nobody warns you about. A big winning trend does not feel triumphant while you hold it. It feels terrifying because every day of open profit is a day you could give something back, and your brain treats an unrealized gain like something being stolen in slow motion. Seykota felt that and held anyway. That discomfort is not information. It is simply what riding a winner feels like from the inside. Learn to recognize it, name it, and keep your hands still. The traders who make the giant returns are not the ones who feel calm. They're the ones who feel the same fear you do and have trained themselves not to obey it. 5, and this ties the channel together. Notice that trading with the trend is really a test of your relationship with being uncomfortable. Fighting the trend, taking the quick profit, shorting strength, buying weakness. All of it is you reaching for the comfort of feeling smart and safe right now. Riding the trend is you tolerating discomfort now for a payoff later, which is the exact same inner skill as cutting a loss, sizing small, and waiting for your setup. It's all one muscle, the ability to feel the pull of the comfortable wrong action and choose the uncomfortable right one. The trend is just the place where that muscle pays the most, because the reward for enduring the discomfort of holding a winner is the occasional trade that changes your entire year. Let me be honest about how this skill develops, because expecting it overnight is how people quit. At first, you'll do everything right, identify the trend, enter on the pullback, and then panic exit the first time it wiggles, giving back most of the move to your own nerves. That's normal, that's stage one, and it's frustrating because you saw the trend correctly and still couldn't hold it. Then you'll start holding a little longer, but you'll white-knuckle it, staring at every tick, exhausted. Then, eventually, you'll hold a real trend to a real structural exit and feel almost nothing because you've stopped comparing it to its high water mark and started trusting the plan. That calm is the skill, and it arrives quietly, not as triumph, but as the absence of the old panic. Expect to regress, especially right after a big winner, because success makes you want to protect, and protection makes you cut the next winner too early. The Wizards didn't feel this less than you. Seykota felt the same pull to take the profit that you feel. He just spent years practicing not obeying it, one uncomfortable hold at a time, until stillness became the reflex and grabbing became the exception. Let's stand back and see the whole thing. The trend is the most powerful and reliable edge in markets, defined not by opinion, but by structure. Higher highs and higher lows in degrees nested inside each other. We fight it because trading with it feels stupid and trading against it feels smart. And Douglas showed us why. We're imposing a belief about fairness on something with no obligation to be fair. The Wizards, Dennis and Seykota and Jones, built fortunes not by predicting trends, but by aligning with them and enduring the discomfort of holding. Because a tiny number of giant winners pays for everything, and only holding lets those winners grow. Trends end when their structure breaks, not when they feel high, which means you can ride them far longer than your fear wants to. Murphy gave us the map, the moving average, and the structure. Douglas told us the enemy was inside, and the trend, patiently, keeps offering the same deal it always has: tolerate the discomfort and align with the most powerful force in markets instead of dying on the hill of being clever. So here's what I want you to carry out of this. The next time you feel that itch to short something strong because it's too high, or to grab a quick profit because holding feels unbearable, I want you to recognize that feeling for exactly what it is. Not insight and not a character flaw, but your nervous system's ancient survival alarm going off, trying to protect you from a threat that isn't real. You cannot beat that alarm with more discipline. You beat it by understanding it, by gently teaching your body, one held winner at a time, that uncertainty is not the same as danger, that a moving trend is not a predator in the grass. That is the real work, and it is quieter and kinder than the war you've been waging with yourself. The trend is not asking you to be smart. It's asking you to be still, and stillness comes not from force, but from a nervous system that has finally learned it is safe. And stillness, in a mind trained to grab and flinch and fix, is the rarest edge there is. If this changed how you see a chart, tell me in the comments. Are you a fader, someone who keeps shorting strength and buying weakness? or a chaser who takes profits too early and never lets a winner run. Name your pattern. Naming it is how you start to break it, and your honesty gives the next trader permission to admit theirs. If it helped, share with one trader who keeps getting run over fighting the tape, because this is the video that explains why. Subscribe if you want to keep going. We're building a complete picture of how the market really works, one uncomfortable truth at a time. Next time, why every trader you admire keeps a written trading plan and treats it like law, and how the absence of one quietly guarantees you'll trade your emotions instead of your edge. Until then, remember, the trend is not your friend when it's convenient. It's your friend when it's uncomfortable. Hold on. I'll see you in the next one.